From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, September 30th, and you're listening to the Macrocast, brought to you by Penta and Markets Policy Partners. I'm Matt McDonald, president of Penta, filling in for Tony Fratto. I'm joined, as always, by John Fagan and Brendan Walsh from Markets Policy Partners. If you haven't listened to the other
what the heck is Penta?
Penta podcast this week, you may be asking what the heck is going on. If you've been watching the markets this week, you may be asking what the heck is going on, which we will talk about. But just to clear the decks is over the past year, Hamilton Place Strategies has been joining with a number of other firms to build a data and intelligence-driven stakeholder solutions platform. That platform launched this week as Penta. We're very excited about it. And but for all of our loyal listeners, the Macrocast is going nowhere, so you can still tune in every Friday to get your fix. And I know everybody's going to be tuning in this Friday because we've been busy at Penta, but the markets have also been busy. John, do you want to take it away and give the recap of what's been happening in bonny old England?
Yeah, thanks, Matt, and congratulations on the exciting developments and Penta and your leadership of this. It's really exciting, and I know you guys have just pulled as a team together and worked so hard to accomplish it. So it's a tremendous, really tremendous, and looking forward to seeing and learning more about all of what you're going to achieve as Penta. So
thank you.
Yeah, so this week, it seems like we've had this week has seemed like kind of a month long week in markets, an eternity. We began the week at last Friday. If we flash back to last week's Macrocast, we were heaping criticism on the UK government plan, the unfunded tax cuts, which followed quickly on the heels of the massive home energy and heating basically capped prices / massive household and business bailout in the face of a cost of living, cost of doing business crisis. It's not an easy job, but that Prime Minister Truss has walked into. But it's hard to look at the outcomes that we saw over the past week and say that they're handling this in the optimal fashion. Markets were verging on disorderly at the end of last week following the announcement of the budget. And this is coming after the, hot on the heels of the Fed's 75 basis point rate hike the previous Wednesday, which was accompanied by extremely hawkish increases in their estimated rates projections, aka the dot plot, which had obviously unsettled bond markets, global bond markets, and moved the dollar into even higher 20-year highs. And so the stage was really set for this. It wasn't necessarily a foregone conclusion that the UK would be the locus of a disaster, but when the Fed doubles down on hawkishness with the dollar at a 20-year high, you can bet that something's going to break. And it was the gilt market, and we wouldn't necessarily have expected that. And things accelerated into even further disorder earlier this week. We saw these jaw-dropping increases in yields, aka sell-off in the gilt market, trading like, to say it was trading like an emerging market is, I think, unfair to emerging markets. It's trading like a really badly run emerging market.
One thing it's interesting. I don't feel like fiscal policy and monetary policy globally has been super on the same page over the past couple years in general. It's just not clear that they've been so not on the same page as what went down in England in fairly short order. And the response, is clear.
Absolutely. And it was that combination of punches. I mean, you had obviously, the Fed, the dollar, the pound was, hardly doing great, and gilt markets alongside global sovereign bond markets in general were in a very unsettled kind of circumstance to receive this news. And as you say, the fiscal situation over the past few years has really been teed up by the fact that debt service costs are very low. And whenever you looked at the metrics about the sort of scare stories about fiscal expansion and runaway deficits and so forth, and the counter to that was always, interest rates are so low, and so the debt service costs are modest. Well, that's obviously that world is now behind us, and we're into something that looks like structurally different, structurally higher rates, and it's the central banks are making policy based on tackling inflation in a very single-minded way. And you might argue, as we have on the Macrocast, that single-mindedness of inflation fighting is ignoring other factors, one being that fiscal burden that is high and growing in a lot of cases, and growing quite quickly in the case of the UK.
I mean, the other piece of this that I think it's been happening for months, and we've been talking about and tracking, but I think this really set it off, is just, the Fed impact of Fed policy across the entirety of the world, and what the strengthening of the dollar has done to other economies and all the rest of it. I mean, this is stuff that we've obviously seen some of this happen over the past several decades, but I'm mindful that the last time that we really had an inflationary environment that people think of as the Fed fixing inflation was late 70s, early 80s, when globalization was not where it is today. And it does, the global impact of Fed policy is an order of magnitude different today than it was in the past. And the feedback loop effect of how that may weaken other economies in a global scenario is just different than it has been in the past. Do you all get the sense that the Fed is actively thinking about that? How are they approaching that question?
There's no evidence that has been a significant consideration in their policy making up until maybe just this week, right? When you have essentially a near meltdown in UK financial markets, that gets through to policymakers in a way that, average and within the normal bounds of market activity kinds of sell-offs don't. And so, the fact that the Bank of England had to step in and restart purchases of government bonds in order to save the pension funds. And we can get a little bit into the mechanics of that. But, essentially the pension funds were going to be making margin calls and had the potential to topple over. And so when you have a central bank that is hiking, is set to hike rates and is buying bonds, that's like driving with your foot on the gas and the brake at the same time. It's not. It's a great way to ruin your engine, and it's a very challenging thing for monetary policy to stay coherent in that kind of environment. The Fed this week, Fed speakers have come out. While the headlines have said, the Treasury Department and the White House are engaging with the UK, trying to, get them to change course or moderate some of the spending and fiscal plans and that sort of thing, the Fed has been, for the most part, singing exactly the same tune, talking about how aggressive they need to be and where inflation, and we got some inflation numbers this morning, which, in it, all else being equal, would support that sort of hawkish bent. But we did have San Francisco Fed President Daly and Chicago Fed President Evans coming out this weekend talking about, like, we've got to be careful about overdoing it. Yeah, you think?
Oh, but John, you made a point there that I didn't realize. So the UK doesn't have to do all these tax cuts. This is a choice on their part. They could just not do it.
I think in the UK they call that an own goal.
I mean, Brendan, you've been quiet so far, but I didn't know you weren't paying attention at all. I mean, come on.
John is a better summarizer of what's going on. Especially when things are annoying. I get annoyed. Yeah, I feel like we're producing a lot of own goals.
What do you guys? I mean, I've seen comment. I mean, At least the articulation over, I mean, the defense of this is that this is really a market problem fixing the plumbing type of thing, as opposed to really driving with your gas and brake. It's shifting gears, or I don't know. It's like changing oil while you're driving. I don't know what the right analogy is, but do you guys, does that explanation bear out for you guys, or are you kind of skeptical of that?
Well, I mean, you can make a distinction between, restarting quantitative easing, which is not really what they did, but an open market operation where they came in to still the waters, the very choppy waters in their bond market. But, I think the expectation is that, there's a continuum between these things, and, continuous need to do open market operations. Like, where does that cross line into essentially like a QE program? We've seen this kind of gray area before. And, the markets have now marked up the expectation for interest rate hikes. I mean, at one point earlier this week, there was an expectation that the Bank of England at its next meeting would have to go 150 basis points. And so that really, and that's in reaction to the idea that they do now have a foot on the gas, so to speak, in terms of the stimulative effects of buying assets, but also to try to stabilize the currency. And that's a classic emerging market motif. Your currency weakens while your bond yields go up, and so essentially the central bank has to chase that and raise rates even faster to try to stabilize. And it's a very negative feedback loop for the economy in particular. And so, that's the pound has rebounded a little bit after, it was down almost 8% versus a dollar to record lows. It has retraced some of that. But, this morning, the news was that Prime Minister Truss and her economic team met with the budget office, came out of there and said, nope, we're sticking with the plan. No change, full speed ahead, nothing to see here. Cheerio, carry on, and so forth. And the pound is predictably back down. So it's not at all clear that this is entirely behind us. And with the Fed, forging ahead, all indications for a continued breakneck pace, and maybe even more hawkish. Who knows? Given what we saw this morning, then the pressure is on. And it's not just the UK. China intervened in the currency to stabilize it. We've seen that in another couple of Korea and other places. So it's not exactly just isolated. It's easy to just say, oh well, the UK blew it. The government blew it, but this is a really global pressure.
With that happy context, let's take a quick break and come back and talk a little bit about where the rest of the world is on this stuff, where the real economy is as well.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
Okay, we're back with the Macrocast. John, you mentioned China. Let's talk about China for a second. I mean, there's been a lot of talk. I mean, I forget when Evergrande hit initially, but China's been on its own journey as well in terms of like continuing with very restrictive COVID policies that have been an economic drag. They went through their phase of cracking down on their technology companies. They're having a real estate blow up at the moment. You continue to have, I would say that the exercise with Russia and Ukraine gave some multinationals some pause about, potential like longer term risk in China that they may not have contemplated before. You saw news recently that Apple is shifting some of their production, all of that in the context of the coming, 5-year party Congress, I guess, that is just around the corner for a unprecedented extension for Xi on this stuff. What is going on over there?
Yeah, this is a problem that's been a long time in the making. The first discussions about China is going to have a debt problem and blow up. Brendan and I were still at the hedge fund, and I was I was in China in 2010, and there were already discussions about that. They were canceling meetings with the finance ministry when groups of investors were asking inconvenient questions about the size and the sort of fiscalization. Like China, after you can make the claim, and I think it's supportable, that China's massive fiscal stimulus after 2000. After the global financial crisis, late 2008 into 2009, was one of the things that really saved the world. But one of the reasons that it has this legacy problem that's kind of so complex is because they essentially used the private or the state banks, and even the private banks to some extent, as the conduit of that fiscal spending. They told the banks to go out and lend. At the time it made sense, which is, hey, you guys are closer to the customers, what loans to make that are going to be good and that sort of thing. But just with the sheer volume of money going out the door, that was going to end up with legacy debt problems. It's not federalized, so to speak. It really is spread out, and the central government has been very unwilling to wholesale kind of take on those bad debts of the big state banks and of the provinces, the local government financing vehicles that have done a lot of those loans. And so Beijing's told them to do it, and then it's now telling them to clean up the problem. So this is, and they've had successive waves of, when the economy has slowed down, they've hit the gas again in terms of credit. So we've seen this, again and again over the past, decade plus. But, in recent years and under President Xi, he has tried pretty strenuously to, stop that cycle. And, it's a road to nowhere. And so he has, they have essentially abandoned their growth targets. They have decided to take some of the pain, realize some of the losses. It's now in smaller banks and, property companies that aren't necessarily as systemic and can go to the wall. The bigger ones like Evergrande that are totally wobbly, obviously losses are going to be crystallized there. But the government is making sure that they're still, that the home buyers are not taking a beating, because that turns into a political problem. And that political problem is manifest in this, you've heard the stories of the mortgage boycotts and that sort of thing. It's not something that is very predictable, and it's a very novel kind of protest, so to speak, but Beijing can't possibly be happy about that kind of development. Do they have the wherewithal to forestall like a market seize up? We saw this kind of really problematic price action in the renminbi in 2015 and 16, and it resulted in what they called at the time the Shanghai Consensus, the G20 in Shanghai. And at the time, Fed Chair Yellen and a bunch of the others went over there and came out with almost like a coordinated, easing off the tightening cycle and trying to calm global waters and that sort of thing. There doesn't appear to be any sort of coordination like that these days. It's sort of every central bank for itself. With the Fed charging ahead at the breakneck pace of tightening that it has chosen, and putting currencies like the renminbi at the lowest level since 2008. This is not a great sign for China. They have the ability to keep things from kind of, it's more likely to be ice than fire, because, a long, slow realization, these legacy debts drag on economic vitality, and they're going to just keep missing growth targets. And that's a long slog, and it's a pretty dismal kind of medium to longer term view, but that's the reality. It's better than, a great kind of shock therapy, which Beijing is definitely not going to favor.
Yeah. The continual missed targets in consulting, they call that the hairy back, where like the curve is supposed to keep going up, but it just goes flat, and you keep, it's over time, it gets real ugly.
It's appropriately gross imagery for that.
Yeah. Well, it is appropriate. And I mean, why don't we complete our tour of the world with EU, where Russia is doing their latest staged vote, I guess, for annexation. What's going on in Germany?
Yeah, so Germany is really all about they're enmeshed in this furious stagflationary battle where you have the German inflation rate came in 10%. No one wants to see double digits. Germans, the Bundesbank and the Northern Europeans on the European Central Bank are pushing for another 75 basis point increase at the next meeting. The euro is way below parity with the dollar, 20-year lows for the single currency, and really like no relief in sight. We saw this week the explosions that basically took out Nord Stream 1, and all kinds of speculation about that. But the reality is Germany and Europe are going to have to be without Russian gas for the most part, and Russian oil, and that's it. This is the big winter, right? I mean, Putin has, time is not on his side. Everybody's seen the comically and grimly comic call up of these poor cannon fodder type reinforcements here, and things are not going his way on the ground in Ukraine, clearly. And this is the winter where he needs the West to buckle. And he needs the West to be so cold and frigid, and just if we get through this winter, I agree with the view that he's lost just an enormous amount of leverage. And so it's not surprising to see him absolutely pulling out all the stops. And, is in the face of that, is it the right policy? And we've debated this before. Is it the right policy to drive your economy into a ditch if you're a central banker? What is the right, but you've got 10% inflation. What do you do? And Putin knows that this is that this is exactly the quandary that he's putting them in. It's doesn't make it any easier.
What about, we've talked a fair bit about Fed policy, but where is we got GDP numbers in this week, right? And even as we go, it does seem like some of the drivers of inflation that we have talked about over the past year are really easing off. Labor market accepted, but you've seen real collapses in shipping costs and kind of shipping. You've seen gas prices decline off their highs, energy prices decline off their highs. So there are parts of this that, at least back when we were talking transitory, the parts that were supposed to be drivers of transitory do seem to have dialed off, even though last measures of inflation, which were a while back, remained elevated. Where is there differing views in the market and the Fed of kind of where the direction of travel is for the U.S. economy and inflation? Because it does feel like, it feels like a little bit of like the Fed is doing as much kind of credibility restoration as they are kind of managing actually where this all lands.
Yeah, and they're honestly even saying that we have to keep tightening to maintain our credibility. Like, they said that out loud. The risk is that it comes down to housing, where housing is the largest component of the CPI, and obviously still a large part of the PCE. But the way that they measure it is very, very backward looking. It's also a 6-month rolling average. So those prices and it's measured on how much you can rent your house for, not how much your house is worth. Those prices are remaining elevated because they came down so much during the pandemic when everyone moved out of the major cities. So it's a screwed up measurement anyway, and it's going to remain elevated for the next few months. It will start coming down in the beginning of 2023, but that would be too late. They probably would have already over tightened by then. The problem is we have real time data that showed that rental prices came off in August. We also have real time data that shows that housing prices came down in August and September. So they're looking at very, very backward measurements of inflation while ignoring the deflationary environment that most of the components of the CPI are actually in, but it's going to take the CPI a long time to capture that.
Where does that leave everything? How does the markets it basically feels like the markets are kind of splitting the difference between a Fed that seems determined to continue raising rates, an economy that feels ready to buckle is too strong a word, but an economy where the inflation is coming off, the growth is coming off. I mean, how do the markets see where this is going to land?
I think the markets are going to be a big factor. So interesting. We also have a big gap in meetings. So the December meeting is late. So we'll get 3 more CPI prints before they have to make their next decision. We'll also get 2 to 3 more of everything in that time frame: jobs numbers and growth numbers. And we just got the Chicago PMI print, which came down to 45.7. So the housing market, I mean, the employment market is still holding up strong, while a lot of the forward-looking growth indicators are now in contractionary territory. But it's also dangerous to look just at the housing market because, I mean, the employment market, because the labor market was so skewed by COVID. We don't necessarily can't compare pre-COVID numbers to post-COVID numbers, especially in terms of the slack in the economy. Now, John, earlier when we were talking off camera, you made an interesting point on that front.
Yeah, I mean, there's just like the sense that the Feds, they know that this operates with a lag. They're looking in the rearview mirror at at inflation numbers that came in last month. But when you're looking at like any market-based gauge of inflation expectations or the expectations that are coming through in the New York Fed survey, they keep talking about how they're very worried about expectations. The 10-year break even, the key market-based gauge of inflation expectations, is down to 2.2%. That's lower than it was in 2001. Yeah. And these are collapsing. And when you look at the ways in which the surveys we're going to get, University of Michigan surveys, all of these expectations metrics are coming down. So I understand that they want a message, and if they want to, there seems to be like they want to overdo the messaging so that everybody like really takes them seriously. But at the same time, you've got to acknowledge that things are going in the right direction.
And also you can read that. So you can read it one of 2 ways: is that the market is giving the Fed credibility that they'll bring down inflation. Yeah. But I think it's actually even farther. The Fed actually doesn't think the Fed is credible. They think that the Fed is going to drive us into recession, which is going to drive down inflation.
Yeah, that's extra right. Credible.
Yes, and that's exactly what That's what the stock market is, in very recessionary. The 10-year, the bond market, clearly with the inversion, it's the deepest inversion since like the 80s, right? They've been blaring, and now
and that's been for a long time now.
Yeah, and more and more CEOs are coming out and saying, yesterday it was Meta and Apple, preparing for a downturn.
There is that. I mean, if you go back during the 80s breaking of inflation, there was that period where the Fed let off and then inflation ramped back up, and then they had to ramp back up too. So I don't know how much that's factoring into the thinking, but you can tell that they just want to do this once and be done with it.
I guess so. They keep saying that, like, oh, we don't want to ease off. You're not easing off. You're going from 75 to 50. Yeah. You're going from like 5th gear and driving straight into a wall to like cutting. 4th gear and being able to make the curve, right?
Well, I think, I mean, the interesting thing is that it wouldn't surprise me if when it dials back from the current strong language, if it's not a similar, I mean, you guys remember that I forget when it was like the winter or spring where the numbers came out. I mean, the inflation numbers came out aggressive, and they basically executed a messaging forecast days before the decision that, hey, we're going to be aggressive. And it was like a complete pivot from the Fed. And I do kind of feel like this is going to be, I think if we get a signal that they're going to start moving from like 75 to 50 or whatever, I feel like it's probably going to be like days before the announcement is done. They're going to go, I mean, it's like they're playing chicken with the market, and they're going to go as hard as they can, as long as they can until like the last second if they're going to make a rate change.
I agree with that.
So stay tuned, everybody. You heard it here first.
Yeah, but their goal is to drive down the equity market. That they've said it out loud, and they also say that it works with a lag. So But one market that doesn't really work with the lag is the housing market. And the housing market is basically, it's in recession and it's entering depression territory.
I mean, mortgage interest rates are what, up at around 7 these days?
We're at 7 now.
The impact on affordability and what you have to make to afford a median home price it's gone through the roof. I mean, it's
you're also going through a seasonality time where people just don't really move in the winter. So
correct.
The numbers are just going to get worse.
And you have, like, if you're sitting on a good rate, you're not moving.
No, you're not. So you're going to see a slowdown in not just housing movement, but also just general movement, which is productive. Someone might not take that new job because they don't want to lose their 2.5% 30-year mortgage.
Yeah. What guys, what do we have on tap for next week?
So the big number is the non-farm payroll, which will be obviously always an important data point, but especially now. And then we have kind of a lot of geopolitical things. The election down in Brazil. OPEC is already hinting that they're looking to cut oil production. They're playing a fun game of chicken with the markets and the world. And other than that, it's somewhat quiet on the data front.
All right. Well, thanks for chatting today after a busy week. Thanks for everybody tuning in. This has been the Macrocast. We'll see you next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.